The Great Depression, 1929 to 1939, was one of the most severe economic crises of the 20th century. It originated in the United States with the stock market crash on October 29, 1929, known as Black Tuesday. Its impact quickly spread worldwide, resulting in a decade-long period of economic hardship and financial instability. The root causes of the Great Depression were complex and varied. One major factor was the speculative boom in the stock market during the 1920s. After the end of World War I, the U.S. economy experienced rapid growth in industry and business, attracting investors who had confidence and optimism about the stock market. The rapid rise in stock prices created a stock market bubble, with stock prices exceeding their actual value. Many people believed that stock prices would continue to rise, considering stock investment as a simple way to accumulate wealth. This speculative mentality led to excessive leverage, as individuals borrowed money or used stocks as collateral for loans, seeking higher returns through leveraged trading. The emerging mass media fueled the speculative boom by extensively promoting the prosperity of the stock market. Media reports of successful stock market stories instilled confidence in investing. In this atmosphere, people started to overlook risks and blindly engage in stock trading, neglecting the stability of long-term investments. This blind speculation eventually led to stock market instability and collapse. The stock market crash on October 29, 1929, marked the beginning of the Great Depression. It resulted in billions of dollars in losses, wiping out the savings of many investors. Consequently, consumer spending sharply declined, leading to reduced production and widespread unemployment. The Great Depression had a worldwide economic crisis, extending beyond the stock market. Bank and financial institution failures led to severe credit tightening and capital scarcity. Companies faced declining demand and profits, leading to production reductions and worker layoffs. The unemployment rate reached approximately 25% in the United States. Bank failures resulted in credit tightening, making it difficult for businesses and individuals to obtain loans and financing. Bank failures eroded consumer confidence, leading to decreased economic activity. Widespread sell-offs of stocks occurred due to the loss of investor confidence, culminating in the stock market crash. Businesses faced declining demand and profits during the Great Depression. Consumers' reduced purchasing power due to unemployment and poverty led to a sharp decline in goods and services demand. Companies reduced production and laid off workers due to declining sales and excessive inventory. The unemployment rate soared, resulting in social unrest and poverty. The Great Depression had a chain reaction on the global economy. Many countries were severely affected, international trade declined, and a global economic recession ensued. Many countries implemented protectionist policies, exacerbating international economic tensions and limiting global trade and economic recovery. Governments initially adhered to a non-intervention policy, believing in self-correction. However, as the situation worsened, they implemented measures to stimulate economic activity and provide relief. These measures included public works projects, increased government spending, and social welfare programs. The Great Depression began to ease with the outbreak of World War II. Governments increased efforts in wartime, stimulated economic activity, and reduced unemployment rates. Increased military demand led to the expansion of the defense industry and economic recovery. Governments promoted industrial development through military spending and war mobilization plans. Despite some relief during the war, the impact of the Great Depression remained profound. It eroded confidence in the financial system, making economic recovery more challenging. The Great Depression prompted governments worldwide to adopt regulatory and reform measures to prevent future economic crises. Stricter financial regulations, strengthened bank supervision, and risk control were implemented to ensure financial system stability. Economic stimulus plans were introduced to promote employment and growth, preventing the recurrence of similar economic crises. In conclusion, the Great Depression was a devastating economic recession that emphasized the importance of prudent economic policies, financial regulation, and international cooperation. Governments took proactive measures to ensure financial system stability and sustainable economic development. Lessons learned from the Great Depression continue to guide the international community in addressing economic challenges, aiming for stability and people's well-being.